Monochrome Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monochrome.
Hello and welcome to the Global View. On this Tuesday, I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's check what happened overnight. Global stocks modestly higher while bond yields eased ahead of US inflation data midweek. Gold and oil surged as tensions rise in the Middle East. The stocks on Wall Street were mixed in choppy trade, with the NASDAQ making gains by the end of the session, while the small caps continue to come under selling pressure. Starbucks rose on reports that activist investor Starboard Value, which holds a stake in the coffee giant, wants the company to take steps to improve its stock price. KeyCorp shares jumped higher after Canada's Scotiabank bought a minority stake in the US regional lender in an all-stock deal worth $2.8 billion. Canada's Barrick Gold beat estimates for second quarter profit as the company benefited from higher prices and strong production, with its average realised gold price jumping 19%. Copper prices up 22%. Hawaiian Electric plummeted after the utility firm raised going concern doubts over wildfire settlement financing. Well, US Treasury yields have eased ahead of US inflation data on Wednesday, which is seen as pivotal for the Federal Reserve's decision-making at its next policy meeting in September. Meanwhile, Fed Governor Michelle Bowman has softened her hawkish tone, saying should the incoming data continue to show that inflation is moving sustainably toward our 2% goal, it will become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restrictive on economic activity and employment. And the New York Fed's Consumer Expectations Survey has shown inflation expectations for the year ahead has fallen below 3%. The yield on the US 10-year note down to 3.9% and the 2-year at 4%. And the Japanese yen has continued to fall against the US dollar as investors consider the ultimate aggressive Fed interest rate cut next month. The Aussie trading at 65.9 US cents. Well, much to unpack, of course, over the past week. Let's do that now with Steve Sosnick. He is joining us from Interactive Brokers. Steve, very good to catch up with you. As I mentioned, a lot has happened over the past 7 days. Some fairly muted action, I guess, on Wall Street in that session just gone. But overall, is it fair to say perhaps the bulls are back in control?
Good morning, Andrew. For now, they are, because as usual, we've been very well conditioned to buy any dip. And we've also been very conditioned to, exercise FOMO whenever possible. And so, the dip materialized. It was a bit of a selling flush on a week ago. And then, you've had this people powering back in because they're too afraid to have missed a buying opportunity. And so, off we went last week on the slimmest of economic numbers. I've never in my career seen the market rally do anything actually on weekly jobless claims. It's just sort of another data point, but to get a 2% rally is unheard of. And so, we'll find out. As Fed Governor Bowman just said, the Fed is data dependent. Well, we're finally going to get some data this week. We really didn't get any data last week. Now we'll get some between PPI tomorrow, CPI the day after, and retail sales the day after that. That'll be some data for the market to chew on.
What does that tell you about the state of the market where it's hanging on every data point?
It tells you people desperately want rate cuts, but they've wanted them all year. And the Fed funds futures market has been so far ahead of the actual Federal Reserve for so long that I think every little hope of any sort of monetary policy easing is taken as potentially terrific news. And so, why let a good crisis go to waste? I think a lot of traders were thinking in terms of, the yen carry trade imploding, sort of short volatility trades imploding. Um, you know, we've done well out of various crises before when the Fed's reacted, and I think that's kind of what the market's hoping for yet again. But what it tells me is the market's done a whole lot of heavy lifting without the Fed lifting a finger. So, what do we need it for necessarily?
Yeah, good point. Steve, you mentioned the data coming to us this week. Look, short of actually a shock in inflation, is the focus going to be more on that retail data just to get a state of the American consumer and how they're spending at the moment?
I think you hit upon something very important. A lot of consumer stocks, particularly those that are travel related, have been doing very poorly after their results. I can bore everybody with a litany of stocks that got sold off, like Airbnb, Delta Airlines, et cetera, that are travel related, which tells you that the idea at least of what we called revenge travel, just people getting out there because they couldn't before, that's fading. And the question now is, we saw a lot of consumer goods companies have rough times during earnings because it's not clear that they're able to pass along any more price increases to customers. And so we'll start to hear actually not only from the government's retail sales, but in the next couple of weeks, we'll start to hear from major retailers like Walmart, Target, et cetera, and find out, if this, if a little bit of a rise in unemployment rate is starting to impact people psychologically, maybe more than just a couple of numbers might indicate.
What are you making of volatility? Of course, that spike was quite something to be seen last week, wasn't it? Now, of course, that dissipated, but I guess traders would delight, wouldn't they?
Well, it hasn't fully dissipated, but yes, that was a trading opportunity for those who are nimble, and hellish for those who are caught on the wrong side of the trade. Um, as you've been, as you and your guests have been discussing for days, a lot of it stemmed from the Japanese carry trade, where, I termed it carried in and then carried out. But what also happened was as Japan started to melt down as a result of the carry trade, and as you saw some of the US high tech leaders, which had been also recipients from the carry trade, it spilled into a second very popular overcrowded trade where people were basically playing what they call the dispersion trade. And that meant that they were we saw, well, let's say correlation among stocks was at an all-time low, or the dispersion of results was at an all-time high. Those suppress index volatilities. And people started to just get very hot on this idea that index volatility was going to be permanently suppressed. Note to self, it rarely is permanently. And as the stresses started to occur in the pre-market Monday coming out of Japan's, essentially near crash, that then spilled into the short volatility trade because VIX started to rise. And, you had basically both effects imploding upon themselves. And that was the reason for the crazy, crazy opening that we got Monday.
Now, Steve, we've discussed this in the past, and you've said that geopolitics rarely moves investors stateside. However, obviously, we've got those tensions rising quite dramatically in the Middle East with the prospects or expectations that Iran is going to strike Israel. We have seen that reflected certainly in oil and gold. How are you seeing that at the moment? And is this different?
Sadly not. I mean, the stocks today didn't really reflect those concerns. We didn't really see a flight to safety in bonds. Yeah, yields were a couple basis points lower, but that's probably more just trading back and forth. And as I've mentioned to you before, the places to look are oil, gold, and specific commodities that might be affected. In this case, it's really just oil and gold potentially are the main drivers. And those reacted, but the rest of the stock market didn't really care, pretty much as usual. Why, again, why let events several thousand miles away affect our thinking is pretty much the mindset of traders, which, by the way, is what spilled in to make Monday's reaction, a week ago, Monday's reaction much worse, because I think a lot of commentators couldn't process the fact that the troubles were coming from overseas. So they went out and said, oh, this is all being caused by US recession fears that spilled out of the payrolls number on Friday. because how of course can a problem in the U.S. be caused by stuff going on in Japan and globally, and that's why you had these bizarre calls for emergency rate cuts, et cetera. But sorry, this is the U.S. mindset. There's a lot of people who just don't really react to stuff that goes on outside our borders until it's thrust upon them.
Well, yes, we will wait. Obviously, it is concerning as what we're seeing in that region at the moment.
Very.
Steve, good to catch up. Thanks for joining us from Interactive Brokers.
Thanks as always, Andrew. Talk to you soon.
So let's check where we're likely to get going. Look, expecting a flat opening. In fact, doesn't get any flatter than that, doesn't it? We're going nowhere, it would appear. However, that will change as the morning transpires, and we'll get right across that in the open in just a couple of minutes. Stay with us.